Welcome to Co-Investments, the new playbook for LPs to get into private deals. In this video, we'll dive deep into the world of private equity co-investments, exploring why they've become a game changer for both general partners and limited partners. At its core, a co-investment is a direct investment made by a limited partner, or LP, alongside a general partner, or GP, into a specific portfolio company or asset. This differs from traditional fund commitments, where LPs commit capital to a blind pool of investments managed entirely by the GP. What was once a niche activity, primarily reserved for the largest institutional players, has now become a mainstream allocation strategy. The market for co-investments has grown exponentially, reflecting a fundamental shift in how LPs engage with private equity. This growth is driven by increasing demand from sophisticated institutional investors like sovereign wealth funds, large pension funds, and university endowments. These LPs are actively seeking more control, transparency, and potentially higher returns from their private markets exposure. To fully grasp the impact of co-investments, it's essential to understand their precise definition within the private equity landscape. Unlike traditional fund investments, where LPs commit capital to a fund without knowing the specific underlying assets, co-investments offer a direct line of sight. The key distinction lies in the transparency and choice offered to LPs. With traditional blind pool commitments, LPs entrust the GP with full discretion over investment decisions. Co-investments, however, invite LPs to participate directly in individual deals, often post-diligence. This allows LPs to look under the hood of specific portfolio companies. They can perform their own due diligence, assess the merits of the investment, and decide whether to participate, aligning with their specific investment mandates and risk appetites. The market data unequivocally supports the growing significance of co-investments. They now represent a substantial and growing portion of private equity deal activity, demonstrating a clear shift in how private capital is deployed. Industry reports frequently highlight the accelerating pace of co-investment deals. This isn't just a fleeting trend, it's a fundamental recalibration of the relationship between GPs and LPs. The market has matured, and co-investments are a testament to LPs' desire for more direct engagement and GPs' recognition of its strategic value. Now, let's explore the compelling reasons why limited partners are increasingly drawn to co-investments. What are the key advantages that make this strategy so appealing? LPs are attracted by a trifecta of benefits: lower fees and carried interest, increased control over their investments, and the potential for higher net returns. These advantages directly address some of the traditional pain points of private equity investing. The fee advantage is perhaps the most immediate draw. Co-investments often come with significantly reduced, or even no, management fees and carried interest. This means LPs get more of their capital working for them, directly impacting their net returns. LPs also gain greater control and transparency. They can choose to participate in deals that align with their specific strategic objectives, risk tolerance, or ESG mandates. This contrasts sharply with the blind pool approach, offering a tailored investment experience. Numerous studies have shown that co-investments can potentially deliver higher returns compared to traditional fund commitments. This outperformance can be attributed to the fee savings and the ability for LPs to cherry-pick deals that best fit their criteria. Furthermore, co-investments allow LPs to strategically shape their portfolios. They can gain targeted exposure to specific industries, geographies, or sectors they favor, rather than relying solely on the GP's fund-level diversification. So, if LPs benefit from lower fees, why do general partners willingly offer co-investment opportunities? The rationale for GPs is equally strategic and multifaceted. GPs offer co-investments for several key reasons, including facilitating larger deals that might otherwise exceed their fund's capacity, managing fund concentration, and deepening relationships with their most valued LPs. It's a win-win scenario that enables more efficient capital deployment. One primary driver is deal execution. Co-investments allow GPs to pursue larger transactions than their primary fund size might typically permit, without taking on excessive concentration risk within that fund. It's a way to bring in additional capital for compelling opportunities. They also help GPs manage fund concentration. By bringing in co-investors, GPs can avoid having a single asset dominate their fund's exposure, thereby spreading risk and optimizing their portfolio construction. Successful co-investment deals serve as a powerful demonstration of a GP's investment acumen and deal sourcing capabilities. It builds confidence among LPs, potentially leading to larger commitments in future funds. Crucially, Offering co-investments strengthens relationships with key LPs. It fosters a deeper partnership, builds trust, and makes LPs feel more aligned with the GP's investment strategy, potentially leading to easier fundraising for subsequent funds. Co-investments come in various structures, each with its own nuances. However, like any investment, they also carry distinct risks for both LPs and GPs that must be carefully considered. The most common structure is on a deal-by-deal basis, where LPs are invited to participate in specific investments alongside the flagship fund. Alternatively, some GPs establish dedicated co-investment funds, pooling capital solely for co-investment opportunities. Other structures include club deals and co-underwriting, where multiple LPs and GPs jointly invest and share risks. For LPs, key risks include adverse selection, being offered riskier deals, and the challenge of quickly conducting thorough due diligence due to short timelines and limited resources. Understanding these diverse structures is crucial for LPs to navigate the co-investment landscape effectively. Each approach presents different levels of commitment, governance, and potential for customization, catering to a wide range of LP preferences. For LPs, the primary risks often revolve around adverse selection, where GPs might preferentially offer less attractive deals to co-investors. For GPs, the challenge lies in managing the logistical complexities of bringing multiple LPs into a single deal, coordinating reporting, and ensuring smooth communication. Looking ahead, co-investments are not just a temporary trend, they are fundamentally transforming the private equity landscape. Their role is set to become even more pronounced in the coming years. Co-investments are increasingly becoming a baseline expectation for institutional investors. What was once an add-on is now an essential part of an LP's private equity strategy, and market projections indicate continued significant growth in co-investment activity. Technology is playing a pivotal role in this evolution. Advanced platforms are streamlining the entire co-investment workflow, from deal sourcing and due diligence to reporting and capital calls, making the process more efficient and transparent for both LPs and GPs. Beyond the transactional benefits, co-investments foster a deeper strategic alignment between GPs and LPs. This alignment is crucial for the long-term health and growth of the private equity ecosystem. When LPs co-invest, they share directly in the success or failure of specific deals. This creates a stronger alignment of interests with the GP, moving beyond a purely fee-driven relationship to one of genuine partnership, where both parties are equally incentivized for the portfolio company's success. This strategy impacts the entire private equity ecosystem, influencing fundraising dynamics and the overall flow of private capital. Co-investments can unlock new pools of capital and provide GPs with greater flexibility in executing their investment strategies. In conclusion, co-investments have emerged as a powerful force in the private equity landscape, offering distinct advantages and reshaping how LPs and GPs engage with each other. They represent a new playbook, enabling LPs to gain more control and potentially higher returns, while providing GPs with crucial capital and stronger relationships. This trend is here to stay, evolving with technology and market demands. Please remember, the information provided in this video is for educational purposes only and should not be construed as financial advice. Always consult with a qualified financial professional before making any investment decisions. Private equity investments carry inherent risks,